Morning, everyone. Thank you for joining us this morning. We are going to start so long. Please, if you have any questions, just post them in the chat. You can see there's step one. You can just click on the three buttons there at the bottom right for more panels, and then click in the Q&A. And then you can just type your question and press enter. The questions will be answered in the Q&A section. Or I will, if it's relevant, or I can easily stop at that point, I'll answer them then. So please use that functionality. It works quite well. And then we can go ahead. Thanks again for joining us. So just as F&B business clients, one of the things we've recently done was we've started opening up some of the more retail options, investment options that's been available at the bank for a while, and that can be available now as well for more of the business clients. This has been happening now for the past 2 years or so. The reason for somewhat of a delay was because the funds first need to grow large enough such that there's liquidity for all investors. So let's just talk through a couple of things. We want to talk briefly about just what's been happening in the market broadly. And when I talk about the market, I'm speaking primarily about the interest rate and fixed income market. Where are we going? What are the factors driving the next 6 to 12 months? What's driving returns? What products are we talking about, and where do they fit in? What are their purpose? And what's in the funds? What do they look like, etc. So let's just look at the classic view, right? If we look at 3 primary asset classes in South Africa, and we look at the data from 2004 up until last week, what we'll see is this. We will see that at the bottom line, that dark blue shaded area is the returns that cash has given you, right? Cash in a bank account over that time. The purple line above that is what bonds were giving you, right? So you can see bonds outperforming cash, right? I mean, it's slightly more volatile, term is slightly longer, you're taking a little bit more risk. So you can see bonds outperform cash. And then the blue line right at the top is SA equities. You can see how since 2004, that's effectively been the winner, right? It's outperformed all of the various asset classes from 2004 till 2020, right? But that's a very long-term view. If we look at a much shorter-term view, if we look at just, say, the last 5 years, what we'll see is that that dark blue line or dark blue shaded area is still cash. And what you'll notice is that cash has actually outperformed equities over the last 5 years. And bonds have also quite easily outperformed both cash and equities over the last 5 years. This dynamic, right, is as a result of a range of factors, right? Lack of growth in South Africa, relatively high interest rates in South Africa over that period, and inflation was mostly under control as well. Right? But this has also driven investor behavior in a lot of different and a lot of interesting ways. If we look at that chart in a different way, right, the chart on the screen is what's just a relative performance chart, right? What it does is it compares the various asset classes to cash returns. A parallel line means that cash and that asset class is performing broadly in line with each other. An upward sloping line, right? So for example, you can look at the green line sloping upwards from 2009 to 2015, means that asset class specifically is outperforming cash over that period. And a downward sloping line means that that asset class is underperforming cash over that period. And what we can see in this specific space is that effectively since February 2015, what's been happening is that you can see that the various asset classes have actually all underperformed cash, right, with the exception of bonds. So from February 2015 to February 2020, excluding the effect of the coronavirus crisis, right, before taking that into account, property, equity, inflation-linked bonds, and have all underperformed cash. The only asset classes that have actually outperformed cash have been preference shares and bonds, right? Now, you can understand that this kind of somewhat atypical return profile will, to a large degree, change the way investors behave. So let's just quickly see what else has been happening in the last couple of years. Firstly, let's look at the repo rate. Now, for those of you that's old enough to remember the repo rate going back to 1998, will remember that in 1998 to 9, the repo rate was above 20%. But what's interesting is if you look at this, is that from 1999 to 2020, right, over 2 decades, every interest rate hiking cycle, right, was shallower than the previous one. So the hiking cycle in 2002 was less than the hiking cycle in 98. The hiking cycle in 2008 was less than the hiking cycle in 2003. And the little bit of a hiking cycle we saw from 2013 to 2016 was shallower than the 2008 cycle. Also, every trough in every cycle, every cutting cycle, was lower than the previous one. Right? So you can see 2001's rates were higher than 2006 rates, were higher than the 2013 rates, which are higher than the rates you're seeing at the moment. We have, in interest rates in South Africa, seen a continued deterioration at the front end of the curve in the rate as you can expect. Now, this is as a result of a range of factors, one of them being a reduction in interest rates globally. Right? We know that both bond rates and cash rates in the rest of the world has been declining quite steadily now for more than 2 decades. But let's look at one of the other factors in South Africa, and that's the inflation rate. Right? So if you look at the inflation rate in South Africa since 1995, and we look at it in 5-year periods, right, you can see that the average inflation rate from 1995 to 2000 was a little bit below 8%. Then you had the inflation rate from 2000 to 2005. That was a little bit below 6. Then you had the financial crisis in 2008, which caused a significant spike in interest rates, which meant that interest rate rose up again to about 7%. But since then, once again, every inflation rate average was lower than the previous one, with the current last 5 years inflation rate effectively being a little bit below 5%, and the average inflation now for the last decade being below the top end of our 3 to 6% bound. So, and that includes both now the Corona crisis through that period, as well as through 2006 with Nenegate and the oil crisis. So for the last decade, we've actually had inflation relatively contained. And that's also helped to lead to a lower interest rate. So if you combine those factors, right, if you say, well, inflation has been low and falling, cash has done very well relative to other asset classes, outperforming most of them, equities and property has struggled, what has been the effect on the various investors in the market? So what you see on the screen is the additional or the change in AUM, right, in the largest categories in ASISA. Now, here it's important to know ASISA is the Association for Savings and Investment South Africa. They gather a lot of data from all the various savings products in the country. And then they break up the various investment spaces into different types of categories, right? So, for example, everyone should be familiar with the concept of a balanced fund, something with about 60% equity and about 40% fixed income, right? Most asset managers have a balanced fund, and traditionally the balanced fund sector is the largest sector of all the ASISA categories, right? And what you can see is that high equity category is effectively the balanced fund category. You can see that from 2014, there was significant growth in that gray line, which represents the balanced fund category. But from about 2018 to now, there's actually been a decline in assets in the balanced fund. Some of it as a result of poor market performance. Some of it has been as a result of lack of flows to that space. You can see in many of the other categories as well, that general funds is for equity general funds. You can see that also attracted quite a lot of nice flows up to about 2017. June 2018, it was the second most popular inflow category. But since then, it's actually seen a lot of outflows and some deterioration in the market. And that pattern is relatively consistent with funds that have a high amount of equities seeing some inflows, but for the last 3 or so years have actually been struggling to get flows. What has been getting flows has been primarily your money market and fixed income sectors. So if you look at the money market funds, right, that is the yellow line. You can see that flows in the money market space have been relatively consistent from 2014 to 2020. And over this period has been the fund category that's gained the most flows of any combination, of any category in South Africa. But it doesn't really stop there, because the money market category is only one of 3 different fixed income categories in South Africa. You have the money market. You've got a category which is called short-term funds, short-term interest-bearing funds, and you've got something called multi-asset income funds. The short-term interest-bearing funds is the purple line, and the income funds category is the turquoise line, the light blue turquoise line. And you can see 3 of the top 4 funds by flows were either money market, income, or the short-term income portfolios. Investors have, for the last couple of years, shifted their portfolios significantly towards this space. And portfolios in this space has grown significantly. Ashburton, as part of the First Round Group, has certainly benefited from that. We have a portfolio called the Ashburton Stable Income Fund, which is one of the portfolios available to yourselves, which we started, which in June 2016 was just over 300 million rand. It's currently standing at just under 16 billion. Our money market fund, which was a little bit under 4 billion at the end of 2019, is closing on at 11 billion as we speak. Right, so we've certainly benefited from these flows as well. And it's likely, in our opinion, that this shift in flows is likely to continue, but for a different reason to some extent. Right? If you look at this category and this combination of flows, what it becomes clear is that retail investors, to some extent, have been more conservative in the 2017 to 2020 period. Right? Flows into your more aggressive asset classes like equity and your balanced funds have petered off or even reduced, whereas flows to other categories, your income categories, have increased. So there's been a shift from your balanced fund categories more towards your equity categories and more towards your income categories. With things as they stand now, we expect that the income categories will still do well, but for a different reason, and I'll go into that soon. So let's first look at just the relative performances of inflation and what we think is going to happen to inflation over the next year or so. Right. So up on this chart, we've got inflation forecasts from RMB, from FNB, and from 2 outside banks, ABSA and HSBC, just to make sure we've got 4 different options. And what we can see in that chart at the bottom left is the forward inflation forecasts of those 4 banks, right? And you can see that in the middle of next year, there's this spike in inflation. Most of that is a result of base effects. You'll remember that inflation in June, July of this year was very, very low. And as that rolls into your base effect, you'll see a spike into next year. But But the effective forecast for inflation towards the end of next year is somewhere between 3.5% and 4.5%, right? We at FirstRand, at RMB and FNB believe that inflation rate's likely to be closer to 3.5% rather than 4.5%, that being the turquoise and black lines there at the bottom of that chart. So inflation is likely to be relatively contained, and we believe just going to surprise more to the downside rather than the upside over the next 12 to 18 months. With inflation averaging between 3 and 3.5. What does that mean for interest rates? Right? With in front of you is what people expect is going to happen, market expectations for the interest rates for the next 5 years. And this chart looks extremely complicated, but in practice, all it is, it's a representation of forward rates in South Africa, specifically the JIBAR rate. And as you can see there, there's no rate hikes priced in for the next 12 months, and there's about 0.5% of rate hikes priced in the next 24 months. Now, we feel that's a little bit aggressive. We don't think we're going to see 50 basis points in hikes as soon as 18 to 24 months from now. We think interest rates and repo rates are going to be maintained at relatively low levels, at least for the short to medium term. And that's going to affect the rates that we get in bank accounts, fixed deposits, call accounts, etc. So if the repo rate is likely going to remain somewhere in the 3.5% range, it's also likely that cash and call account rates are going to remain relatively where they are now. So what does that mean? Well, one of the things that we know, both in South Africa and offshore, but drawing mostly from offshore experience, is that as interest rates start falling, right, specifically bank interest rates, is clients tend to move up the risk spectrum. They tend to start taking more risk to get higher returns, right? And I'm going to use the money market fund as an example, right? Depending on the type of client, the safest option that they can think of is money in a bank account, right? And moving from there to a money market fund requires a little bit of additional administration. They need to understand how a money market fund works. Money is no longer available within 5 minutes. It's now available either at a T+0 or T+1 basis, so either only later in the day if you put in your instruction early, or only maybe the next day if you put your instruction a little bit later. But as interest rates start falling, the additional yield on a money market fund becomes more and more attractive. If you think about what we think the call rate is going to give you over the next, say, 12 months, approximately 3.2%, then a money market fund giving you 3 to 4.4% suddenly looks quite attractive, right? That 1% additional yield between a call account and a money market fund is not that attractive when you are earning, say, 7%. If a call account is sitting at 7 and a money market fund is sitting at 8, significantly fewer people are willing to take the additional risk for 1% additional yield. With a call account sitting at 2 to 3% and a money market fund sitting at 4.3, suddenly that additional 1% yield represents 25% additional return. And it starts to look quite attractive. The same thing is true for the stable income fund, which gives you about a 1% yield in addition to the money market fund. So suddenly if you're sitting at 2 to 3% in a call account, and you can get 5 to 5.5% in the stable income fund, you are, if not quite doubling your returns, you are adding a significantly additional margin. And both of those portfolios are rated by GCR. They've got official ratings. The money market fund has a rating of AA. The stable income fund has a rating of AA-. So you're not taking significant additional credit risk. Both of those portfolios have T+1 liquidity. And yes, there's some additional administration to access those rates. But suddenly that additional yield looks a lot more worth your while than it did when we were in a lower interest rate environment, or in a higher interest rate environment. I apologize. So, and that is consistent with what we've seen in the US and Europe and Japan and the UK. As interest rates start falling and approaching closer and closer to zero, specifically in real terms, clients start taking more and more risk. They start moving money from bank accounts to money market to stable income. Right? So we expect that the stable income fund and the money market fund will continue to gain flows, but this time not so much because people are moving from equity and balanced to the money market fund, but more because more and more clients, retail, corporate, institutional, etc., are looking for additional returns above what they can access in a bank or a call account. So this you can see is one of the models we run that gives us an idea of what cash on call returns are likely to be. And this is where the data comes from, where we say that we think call is going to give you between 3 and 3.2% for the next 12 months, depending on the type of bank account you have. So let's just look at the general backdrop. What's been going on globally? So there was a question that just came through that's actually quite applicable. So the question is, the money market fund and stable income has shown a declining trend in rates. Has there been any capital impairments on the fund during this turbulent economic period? Okay, so the money market fund invests only in the big 5 South African banks. It invests in treasury bills issued by the SARB, and it invests in international banks with a AAA rating in South Africa, specifically HSBC and Construction Bank of China. Those international banks have international ratings of 4 to 5 notches above the South African sovereign. So they're deemed to be extremely safe compared to, let's say, even South African treasury bills. So the money market fund has seen no capital impairments during this time because you effectively have senior bank paper and senior government paper and international paper. Stable income, however, has seen some mark-to-market changes in valuation on some of the paper, and that has led to a reduction in yields in both March and in April. So the fund during the January-February period returned about 0.65% per month. In March and in April, the portfolio returned between 0.25 and 0.3% for those months. So both months were still positive, but as a result of changes in the mark-to-market value of some of the underlying instruments, the returns for March and April was lower than normal, right? Those were all as a result of the changes in the mark-to-market price of the instruments in the portfolio. The fund comprises both listed paper and unlisted paper, and most of the changes in mark-to-market has been a result of the listed paper, right? Unless there are extreme circumstances, the regulator frowns against us doing manual impairments on listed instruments, as they feel that it can result in the manipulation of pricing. So while instruments continue to trade, let's say, for example, the bank paper or other types of instruments, while they continually trade and change in price, the regulators don't want us to override the market prices of listed instruments. When it comes to unlisted paper, we did do some manual impairments on some of the instruments in there where we felt that was required. FirstRand specifically is very conservative when it comes to the valuation of credit instruments, and it's been one of the strong points of the bank over the last couple of decades. They've been exceptional in their credit books, and drawing on that knowledge of both the bank and both bank lending and bank credit practices, we did look at some of our internal instruments, and we did change the valuations on them, and those impairments have been taken into account. The result of those impairments, because there hasn't actually been any defaults in the book, right? The result of those impairments is that instruments that were valued at 100, earning, let's say, 3%, the JIBAR plus 3, so about 6%, and is now valued at 95%, is now effectively earning JIBAR plus 4 to JIBAR plus 5. So what happens is that those impairments lower your capital value on some of the instruments, but they then result in a boost in the portfolio yield. Because those impairments just change the capital value, and while the interest rates on those instruments still remain the same. I hope that answered the question. Okay, so on this, back to the screen, right? So the US 10-year rate, you can see, towards the end of last year was trading at just below 2%. And then in February and March, that dropped down to below 0.6. But now for most of the last couple of months, these bonds have actually been trading between the narrow band of 0.6 and 0.8%. That is significantly below the expected inflation rate in the US. We know that because if we look at US TIPS, which is US Treasury inflation protected securities, their current yield is at negative 1%. And by combining that, it'll give you a break-even inflation number, which shows you that people are expecting inflation to be between 1.5 and 2% over the next decade on average. One of the reasons the US rate is still so low is because of central bank actions, effectively quantitative easing actions by the Federal Reserve in the US, forcefully suppressing the rate. That combined with a Fed funds rate that's at the lower bound of 0. So those two actions means that the US 10-year rate is to some extent artificially compressed, and is trading between 0.6 and 0.8. And we've heard from the Fed that they expect to keep interest rates depressed for an extended period of time. This chart shows you the Federal Reserve balance sheet since 2005. And you can see how that's increased at every crisis over the last 15 years, in 28, as well as between 2012 to 2014, as well as now from 2019 to now, right? What not a lot of people realize is that the increase in the Federal Reserve's balance sheet actually started in the third and fourth quarter last year already. The big jump was in February and March this year. And as you can see from that line, it's continued to increase. About June, July saw a reduction in the size of the official balance sheet. Most of that was not the Fed stopping their buying. It was on swap lines between the Fed and some other central banks that just rolled off, whereas the Fed continued to buy a combination of government bonds and ETFs, both investment-grade ETFs and even some high-yield ETFs in the U.S. markets, helping to suppress both credit spreads, defaults, and a range of other things in the U.S. Financial markets. This slide is a one-year slide of a range of different emerging market currencies. I've tried to color code them as far as I can. So what you'll see on this slide is right at the top, in yellow is the Brazilian real. You can see that currency's been very weak. A little bit below that, in green, is the rand. The next one below that is a purple line or pinkish line, which is the Turkish lira. And from there on, you've got a couple of other currencies, Poland, Mexico, etc. What we can see from this is that the rand's moves, both in March as well as now towards June, July, as well as the recent strength, didn't really happen in isolation. It happened alongside the currencies of most countries, with the exception of Turkey. The rand has been, over a one-year basis, one of the weaker currencies, but not the weakest. And many of the rand moves is driven more by global risk sentiment. For example, the moves in September was primarily due to global risk off, rather than anything specifically that happened in South Africa. We get hit specifically hard when negative risk sentiment combines with bad news in the local market. So, for example, the fact that in September we saw a risk-off sentiment, and then we combined that with bad news from the SAA bailout, was one of the reasons that both our currency and our bond market moved significantly more than we thought, specifically the moves in our bond market. To look quickly at just the bond market, currently, as we stand now, as of today, actually, the 10-year yield on South Africa's 10-year bond, on 10-year bonds in real terms, in other words, just the current yield on the 10-year bonds, less the current inflation rate, is sitting at about 2.3 to 6.5%. The actual rate is around about 10%. So buying South Africa's 10-year bonds for 10 years gets you a return, and holding it all the way to maturity will give you about 10% per annum return. If you compare that to many countries around the world, you can see that South Africa's rate is actually quite high compared to its peers. Brazil is sitting a little bit above 5%. Indonesia is about 5.6%. Colombia is at 3.8%. Czech Republic is at negative 2.5%. Poland's negative 1.6%. Mexico is at 2%. So in real terms, our bonds are actually showing quite a lot of value. It's just an interesting chart to show people what's happening in that space specifically. From a rand perspective, once again, it shows the rand moves from 1995 till effectively Monday. And we can see that the rand has been steadily weakening at between 4 to 5% per year, every year for the last 25 years. And that's mostly as a result of interest rate and inflation differentials. But the differential economic growth, especially recently, has also impacted the potential strength of the rand, according to our economists. What I wanted to draw your attention to is just the moves of the rand in the past couple of crises, right? So if you look at the crisis in 2001 and the crisis in 2008, what you'll see is that the rand, post a crisis, in a crisis, sells off significantly, and then it grinds stronger over time. And that time period varies quite significantly. In 2001, from the weakest point to the strongest point took 3 years. In 2008, the weakest point to the strongest point took 2.5 years. Once again, in 2016, the weakest point to the strongest point took 2 years as well. That's the one thing that's interesting. The other thing that's important is that every rally from 2001 to 2016, every rally subsequent to weakness was slightly weaker than the previous one. So you'll see there that the rally in 2001 was 25%, and so on. And you can see how big those numbers are. I'll send the presentation on to anyone that's interested. But you'll see that every yield rally is a little bit weaker than the previous one. And the yield rally in 2016 effectively was very short-lived towards the bottom end of that long-term trend. And we expect that the moves that we are likely to see over the next 6 to 18 months will reflect that. In other words, the rand is likely to grind stronger towards the end of next year, towards a fair value of somewhere between 16 to 16.5. So we are not that far from fair value at the moment. And much of the fair value move in the rand will be driven more by the long-term deterioration trend rather than an actual strengthening in the currency. So what I mean by that is you'll see that in 2016, and I'm going to see if I can make an annotation on this chart. Let me just draw with a nice pen. Let me just change the color. Sorry, there. In 2016, this period there, right, to that period there, you can see that the currency was effectively unchanged. But in 2016, we were still up trading above fair value, whereas there towards 2018, we were pretty close to on fair value. And that's because the long-term trend deterioration did much of the fair value move rather than actual strengthening in the currencies. Okay, so let's talk about just credit and credit spreads in South Africa. We know that these two portfolios take in cash from clients, and then they invest in a range of debt instruments out there in the market, right? And the return that clients get is a function of both the base rate, which is the JIBAR rate in South Africa, which is currently sitting around about 3.3%, plus the spread above the JIBAR rate that various corporates pay. And we can see that from 2017 to 2020, there was a steady reduction in credit spreads over time, right? If you combine that with also the reduction in interest rates that we saw at least a little bit, that's one of the reasons that we saw a drop in yield. Since February to now August, what we did see is that there's actually been an increase in credit spreads across all sectors, with SOEs being hit the hardest, effectively seeing a significant increase in credit spreads. And the other one there in the purple line at the top is bank additional tier 1 paper. Now, bank additional tier 1 paper is debt with a similar ranking to preference shares. So it's quite a bit different from the rest of the instruments there, but just it's a chart to show that credit spreads increased across the board. So you'll see there, for example, the purple line, which is non-property corporates, credit spreads before the crisis was around about 150 basis points, 1.5%, and it's averaging now about 200 basis points, or about 2% above JIBAR. So with JIBAR at 3.3, non-property corporates are paying about 5.3% on their debt at the moment, whereas property companies are paying also about 1.5 to 2% as well. Let's just look at another chart. This chart is the probability of default of the big 4 banks in South Africa. I've tried to color code this. So you'll see in turquoise is FirstRand, in blue is Standard Bank, Nedbank, and then in red is ABSA. And what you'll see is just the 1-year probability of default of these banks over time. Now, I show this for 2 reasons, right? The first is just to show that while that risk in banking in South Africa has certainly increased, it still isn't that significant. So, for example, the 1-year probability of default for FirstRand, and this is calculated by Bloomberg, so it's a third-party calculation with a model that's called the Black-Scholes-Merton model. Someone else might know as the KMV Moody's default model. You'll see the 1-year probability of default for FirstRand is somewhere in the order of 0.2 to 0.25% on a 1-year basis. Now, that might not mean a lot to you, but something like Goldman Sachs, for example, 1-year probability of default is between 0.15%. So the difference in 1-year probability of default between one of the premier global banks and FirstRand is about 0.05%. So the risk of default, like a bank at FirstRand, is judged to be extremely, extremely low. Also, for the moment, and relatively consistently over the last few years, First strand maintains either the lowest or one of the lowest probabilities of default across the banking sector. And then you can see there from the other ones that, for example, ABSA and probability of default and the other organizations is about 0.5%. So again, about twice the probability to default of first strand, but still not that significant on a 1-year basis. This is another chart I just want to show you, which is just showing you that the change in yields over the last a couple of years. And the important one on this chart is inflation-linked bonds. It's cash in turquoise. It's nominal bonds in orange. You've got property and preference shares as well. But that turquoise line, this line there, is your 1-year NCD rate. And you can see that was trading alongside most of your other asset classes, and now it's dropped significantly. And that step change down is likely going to change the way investors behave. It's going to drive investor behavior for the next for at least the next 12 to 18 months. Our expectation is it's going to drive more and more clients to look at bank account alternatives, but it's also going to drive clients into taking more risk in other areas. Okay, so let's just briefly look at the money market fund and stable income fund and the product continuum for business clients and what that looks like. Now, I'm not going to talk about anything else on this category, on this sheet, except the two blue bars, Ashburton Money Market and Ashburton Stable Income. The first thing I want to just raise is that neither of these portfolios are intended to be call accounts, right? So you'll see there at the bottom that the money market fund is intended for investments of 1 month to about a year, right? We expect that clients that invest their money in there is likely to keep their money in there for at least longer than a month. It's not the type of thing where you want to put your money in for a day and then withdraw it 2 days thereafter. That doesn't mean you can't. If you put in 20, 30, 50, 100, up to R1 billion in the portfolio, you can withdraw it the next day. The fund does offer T+1 liquidity. It doesn't have lock-ins. It doesn't have transaction fees. It doesn't have penalties. None of those things apply to either the money market fund or the stable income fund. But it's not intended to function as a call account. It's intended to be your first step from there. So any money that you are unlikely to need for the next couple of weeks, up until a month or more, is money that can be placed in the money market fund. And as the transactionability of the money market fund becomes easier and simpler, it is likely that more and more clients will use that. As an example, one of the other big money market funds in South Africa saw a change in AUM of about 2 billion over the last, in the second quarter, right? It went from, I think, about 40 billion to about 42 billion. But it saw about 80 billion of inflows and about 80 billion of outflows, right? So people do use these funds quite aggressively for flows, but it's not, the purpose is not for it to function as a overnight call account. Its purpose is to function as your first step out of that if you're looking for somewhat higher rates. And the current rate on the stable income, the money market fund, is currently around about 4.3%. The stable income fund was created in 2009. I've been managing the portfolio since September 2009. Just as a question on the chat, can everyone hear me? I just got a malfunction I've met perhaps in my headphones. Can I just maybe get Edward just on the chat? Okay, thank you very much, Alex. So the stable income fund was created in 2009 and it was supposed to function as an alternative to money market clients that want to be there for a slightly longer period of time, right? So I've been managing it since 2009. Over that period, we've not had a negative month. And the goal of the portfolio is, as I said, to outperform a money market fund by about 1%, but to also still look like a money market fund as much as possible. The caveat here is that you can see negative days, even sometimes negative weeks in the portfolio, right? It is possible for you to put in 20 million Rand today, and 3 or 4 or 5 days a week from now, you are down 0.05%, right? Those are the types of moves, or 0.1%. Those are the types of moves that you can see. But over a 1 month, 2 month, 3 month period, you are very, very likely to see your money moving back into positive performance territories. That's why we advise clients to be in the stable income fund if they are looking to stay there at least 6 months or longer. Now, as a result of that, clients tend to use a combination of the two portfolios, a segment of the money in the money market fund and a segment of the money in stable income. That will give them a somewhat higher rate. But if they, for some reason, need crisis liquidity, drawing it from the money market fund won't impact their stable income returns at all. So let's just go, what are the differences between the money market fund and stable income? Both of these function as lending books. They lend corporate loans, debt instruments, etc. The difference being that money market fund has no corporate debt in it, no non-bank corporates, and no debt instrument is longer than 13 months in the money market fund. Stable income fund is about 60 to 65% big five bank debt, and about 35% non-bank corporate debt, and where the weighted average term of all the instruments in the money market fund is about 100, it has to be less than 120 days. In the stable income fund, it's around about 3 years. Stable income also has T+1 liquidity. So if you put in 20 million today, and for some reason a week from now you want it, you can pull it out on a T+1 basis. In 99% of circumstances, over that period, you would have grown your money as well. It's only in the extreme case, like we saw in March and April, that you would not be in a positive territory after a week or two. And that's now happened once in the last 15 years. So let's run through some other things just on the portfolios. Money market fund is a double A rating by GCR. We're getting it re-rated again. It's about 11 billion. It's got a cut-off time of 11 o'clock in the morning if you want your money on for the same day, or after 11 o'clock if you want it next day. All the details are there. It's Regulation 28 compliant. It's Board Notice 90 compliant. There's the performance of the portfolio versus our closest peers, which is the big five banks and funds by the big five banks. You'll see we are consistently number 1 or number 2 amongst our peers using the same type of fee classes. So we are quite comfortable with the performance numbers. Over the last year, for example, the fund did 6.5%. That's the asset allocation. You can see various types of instruments: China Construction Banks, HSBC, Investex, Reserve Bank, Standard Bank, Net Group, and Barclays. Stable income has an official rating of AA-. It's about 16 billion. And we try to get the steady composite plus about 1%. You'll see these are the performance numbers against our closest peers. Once again, the bank, ABSA doesn't really have something in this space, but for Net Group Core, 91 steady plus, and the two funds by Stanlib, going back 5 years. And you'll see over the last 5 years, stable income did 8%. Most of the other funds did quite a bit less than that. If you compare that to the money market funds, you'll see the money market funds on average did about 7.2, 7.3. So we outperformed the money market funds by about 80 basis points per year over the last 5 years. That is also the A class, just so we can have a longer return history. The C class, which most of the corporate clients invest into, would have done about 12 to 14 basis points more than that, so about 8.1 to 8.15. That's your asset allocation. You'll see the big 5 banks are very highly represented there. So Investec, FirstRand, Standard Bank, Net Group, ABSA are the first 5 blocks right up to there, right? Then you'll see that block there. That's a component of investment grade instruments sourced by RMB Corporate Credit. There's about 28 different names in that section, which is about less than 0.2% per name. Then we have about just under 4% in the Ashburton Money Market Fund, which is, once again, just big 5 banks. Then we have HSBC. The gray block there is Inguza, which is also a combination of corporate debt by RMB. And our largest single non-bank corporate holding is Discovery, right there at 1.76%. So you can see there's no real significant single name credit risk in the portfolio. It's not like we're going out there and swinging for the fences. We are being very, very conservative in the credit allocation of this portfolio. And that's it for the presentation. We have about 5 minutes left for questions. Please let me know if there are any questions. Unfortunately, I have no questions here on the Q&A. So I really would appreciate it if we can get 1 or 2 other questions from anyone on the call. Well, okay. I'm going to give it another 30 seconds or so for questions to come through. I still haven't gotten anything. That means either I did explain everything perfectly, or it might mean that no one's interested. I hope it's the first one and not the second. Okay. In that case, thank you very much, everyone, for your attendance this morning. I am available, and we will probably be doing more of these. They won't happen too frequently, but if something interesting happens, or if you wanted to just have a discussion about something going on in the market, I am available to do that via Microsoft Teams or some of the other chat platforms. I hope this helped, and that it gave you an opportunity to look into this, and that it can give you and that can help your businesses over the next couple of weeks and months. We also have group economists available for conversations more detailed about other things, or I can brief you about markets or anything else. Thank you very much for your time, and I hope you have a very good day. Thank you. Bye-bye.